Have you ever felt like the whole world of finance is some big, complicated game and nobody ever bothered to teach you the rules? Yeah, you are definitely not alone. So over the next few minutes, we're going to pull back the curtain and break down the stuff that actually controls your money. We'll start with a feeling I think we all know a little too well. Okay, picture this. You've worked hard all month, you get that glorious paycheck notification, and you're feeling good. But then you actually look at your bank account and the number, it's just smaller, right? A lot smaller. So what happened? Where did the rest of that money actually go? Let's figure it out. Our first stop on this tour is your paycheck, and that classic mystery of the missing money. For most of us, this is our very first and usually very confusing introduction to how the whole financial system works. So that missing chunk of your hard-earned cash, where does it vanish to? Well, it goes to taxes. And yeah, I know nobody loves them, but they are pretty much the price we all pay to live in an organized, functioning society. So, what are taxes, really? The easiest way to think about them is as the cost of civilization. Seriously, this is the money that pays for the roads you drive on, the schools in our neighborhoods, public parks, first responders, you get the idea. All the stuff that makes our communities work. And believe me, taxes pop up pretty much everywhere. You've got your income tax, which comes right out of your paycheck. Then there's sales tax, which gets added on to pretty much everything you buy. If you invest, you'll run into capital gains tax. And on that pay stub, you'll also see deductions for Social Security. Think of that as a retirement plan that everyone pays into, and Medicare, which helps fund health insurance for seniors. Okay, so you've got what's left of your paycheck after taxes. Now what? Well, it usually goes to a bank. So for our next section, let's talk about the truth of what a bank actually is. I think most of us kind of picture a bank like it's a giant, super secure vault where all our cash is just sitting in neat little stacks with our name on it. But the reality? It's not that. A bank is actually more like a financial matchmaker. The second you deposit your money, it's not just sitting there, oh no, it gets put to work. And the system that lets them do this is called fractional reserve banking. It's pretty simple, actually. Say you deposit $1,000. The bank is legally required to keep a small piece of that, a fraction, on hand. But the rest of it, say $900, they loan that out to someone else who wants to buy a car or start a business. The entire system is basically a calculated bet that we won't all show up on the same day asking for all of our money at once. So if the bank is just lending our money out, why even use one? Well, there are three really big reasons. First, convenience. Let's be honest, cards and online transfers are just way easier than carrying around wads of cash. Second, they actually pay you a tiny bit of interest for the privilege of holding your money. And third, and this is the most important one, safety. In the US, your deposits are insured by the government up to $250,000. That is a whole lot safer than stashing it in a shoebox under your bed. Now, since banks are basically in the business of lending money, it is absolutely crucial that we understand the rules of borrowing. So this next section is all about two huge concepts, interest and your financial reputation, which you probably know as your credit score. To really get borrowing, you have to get interest first, and the best way to think about it is as rent for money. That's it. If you're the borrower, interest is the fee you pay to use someone else's cash. And if you're the saver, it's the little reward you get for letting the bank use yours. But, and this is a really big but, there are two types of interest, and the difference between them is massive. Simple interest is just what it sounds like, a flat fee on the original amount you borrowed. But compound interest, well, that's where the magic, or the trouble, happens. It's interest that earns its own interest. It's like every dollar you have starts making clones of itself, and those clones also start earning you money. And honestly, this is one of the biggest secrets of finance. Compound interest can be your absolute worst enemy, or it can be your best employee. When it's working against you on something like credit card debt, it can turn a small purchase into a giant regret. But when it's working for you in an investment account, it's like a real-life cheat code, just duplicating your money while you sleep. It's all about who's collecting the interest, you or them. So how do lenders decide if they can even trust you with their money in the first place? They look at this one single three-digit number, your credit score. It's not a measure of how rich you are. It's a grade on how trustworthy you are as a borrower, and that score ranges from a low of 300 to a high of 850. So what actually goes into that score? Well, a few things, but two of them are way more important than the others. Together, they make up 65% of your entire score. First, your payment history. It's simple. Do you pay your bills on time? And second is credit utilization. That's just a fancy way of asking how much of your available credit you're actually using. Pro tip, keep that number low. It's all about showing lenders that you are reliable and not overextended. Okay, let's zoom out for a second. Beyond your personal paycheck and your bank account, there are these huge economic forces out there that affect everybody's money. So let's talk about the two big ones, inflation and recessions. You want to understand inflation? Here is the perfect and sadly very relatable way to think about it. You go to the store, you buy a bag of chips. It costs more than it did last year, and when you open it up, it's mostly air. That feeling of paying more to get less, my friends, that is inflation in a nutshell. The official definition is that inflation is the slow, steady erosion of your money's value. Your $5 bill is still a $5 bill, right? It just buys you less gas, fewer groceries, and a smaller coffee than it did a year ago. Your purchasing power is constantly, quietly falling. And what happens when the whole economy just slows down? Well, that's a recession. Think of the economy like a really big party. A recession is when the music suddenly stops, the lights flick on, and companies start cutting back and unfortunately laying people off. It's a really painful part of the economic cycle, but it is a natural part of it. All right, I know. We've talked about taxes and banks and debt and recessions. It can all feel a little overwhelming. But in this last section, we're going to talk about how you can actually take control and start making your money work for you. The single most powerful tool you have to fight back against inflation and actually build wealth is investing. It's really just the process of trading your money today for more money in the future. It's how you turn your savings from a lazy couch potato into an active employee that goes out and earns income for you. But listen, here is the most important rule of investing, and maybe of all of finance, period. This isn't about getting lucky or picking the one hot stock. The absolute crucial takeaway is that real, lasting wealth is built over decades, not days. The secret ingredient isn't being a genius, it's patience. And if you need to see it to believe it, look at this. This is the unbelievable power of compounding over time. If you invest a small amount every month for 10 years, you end up with a nice little chunk of change. That's great. But if you do the exact same thing for 30 years, the result isn't just 3 times bigger. It is exponentially, mind-blowingly larger. That right there is the magic of giving your money time to grow. So we'll end with this thought. More than your salary, more than what's in your bank account, your single most valuable financial asset is time. Most wealthy people didn't hit the lottery. They just started early and gave their money decades to do its thing. So the real question you have to ask yourself is, how are you investing yours?